The economic telescope. Seeing your startup's future. Startups are like rockets. They need a clear trajectory. Economic indicators are the stars that guide your path. By understanding these indicators, you can anticipate challenges and seize opportunities. This is not just for economists, it's about your startup's survival and growth. Think of it like this. You wouldn't launch a product without market research. Similarly, you shouldn't launch a startup without understanding the economic landscape. Are you heading into a storm or smooth sailing? Economic indicators provide the answer. GDP, inflation, and interest rates, your startup's compass. Three key indicators are crucial for startups: GDP growth, inflation rates, and interest rates. GDP growth is like the economy's heartbeat. A strong heartbeat means more spending, more customers, and more opportunities for your startup. Inflation is a silent killer. It erodes purchasing power and can squeeze your margins. Keep a close eye on it when setting prices and managing costs. Interest rates are the cost of borrowing money. When rates are low, it's easier to secure funding for your startup. But when rates rise, be prepared to tighten your belt or explore alternative funding options. Riding the waves, adapting to economic tides. Startups need to be agile, like surfers riding waves. During economic expansions, be bold. Expand your team, launch new products, and capture market share. Take advantage of the favorable conditions to fuel your growth, but be cautious. Don't overextend yourself. Economic slowdowns are inevitable. When they hit, batten down the hatches, focus on efficiency, cut unnecessary costs, and prioritize profitability over growth at all costs. Section 4: Pricing in a storm. Navigating inflation's impact. Inflation is a startup's nightmare. It can erode your margins faster than you can save venture capital. If your costs are rising, don't be afraid to raise prices, but do it strategically. Communicate the value you provide to your customers. Highlight any improvements or innovations. Consider offering discounts or loyalty programs to retain price-sensitive customers. Section 5: Funding your vision, interest rates, and beyond. Interest rates directly impact your startup's ability to raise capital. When rates are low, debt financing becomes more attractive. But when rates rise, explore alternative funding options. Consider bootstrapping, crowdfunding, or seeking out grants. Remember, securing funding is a marathon, not a sprint. Be persistent, build relationships with investors, and articulate your vision clearly.